Consumer spending continues to be the main driver behind the robust economy. We heard from the big credit card companies in the last week. Visa, Mastercard, and American Express all reported growth in spending across their consumer bases in their most recent quarterly results, with some of the biggest upticks being in travel. Now, each company commented about the strength of the consumer. Mastercard CFO is saying, quote, consumers are still exercising their comfort around their employment status with their spending. Visa mentioning they have seen resilient consumer spending throughout the year. And American Express commented that Millennial and Gen Z consumers continue to be the fastest growing portion of our card member base. Still, each company recognized macroeconomic headwinds on the horizon. Here now with what we can expect for consumers going forward is Ted Rossman, Bankrate Senior Industry Analyst. Good to see you, Ted. So, as we've heard from some of these credit card companies here, what does this mean in terms of the strength of the consumer paying high prices, or is it really about strong demand?
I think it's really both. I think that it is shocking. People keep saying this resilient consumer spending, but it's so true. I mean, that drove a lot of the 4.9% GDP growth number that we got earlier this week. I think it continues to surprise people. Now, it's not all rosy. I mean, more people are taking on credit card debt, delinquencies are rising, prices are up. None of this feels good, but I think at the end of the day, the strong job market is fueling a lot of this growth. And I also think it's notable that there is still a surprising amount of cash and checks in the system. So companies like Visa and Mastercard are benefiting from this ongoing shift towards digital payment methods.
And you note in your notes here, normalization is the key theme on delinquencies. I think a lot of times because we were in such a low interest rate environment for so long, we forget what used to be normal for us. Break that down for us and what that means for what consumers can expect going forward.
I think this is where numbers can sort of play tricks because the more negative glass half empty kind of view would be, oh my gosh, delinquencies are shooting up. They're up 50% from their low. And then the other side of it is they were artificially low for a while. During the pandemic, a lot of people paid down debt with their stimulus money and they were spending less for a while and delinquencies were really artificially low. So I get the sense that the industry is not really alarmed by this rise. Even though it looks steep by some measures, it's really only back to 2019 kind of levels in terms of delinquencies. And some companies like Amex are even lower than that because they have a more affluent, credit-worthy kind of customer base. Last year was a record year for credit card signups, according to Equifax. The first 6 months of this year, which is the most recent data that's available, that came within 1% of that record high. So credit has tightened a little bit, but not overwhelmingly so, not by a long shot. I mean, most people are still finding it easy to access credit. They're keeping up with the bills. Yes, balances are rising, but at least people are paying them back.
And you do raise an interesting point here because credit quality and risk was something we weren't sure what was going to happen, especially after all the banking fallout for regional banks earlier this year. But you're seeing that as being really resilient. At least banks are feeling good about this at the moment.
They are. I mean, honestly, from a bank standpoint, this is almost the best possible environment. This is a kind of Goldilocks scenario because balances are up, spending is up, debt is up, interest rates are up, and yet people are actually paying this money back. That's the big fear, is that what if there are a lot of delinquencies and defaults? I mean, honestly, the banks make a lot of money off of credit card interest. So the more that people carry balances, provided they actually pay it back, that's a real sweet spot for them. A company like Discover really relies on these so-called prime revolvers, people with good credit, who are good credit risks, who tend to carry balances at higher rates. Different companies have different strategies. Amex is more about the transactors, the big spenders who pay in full but pay annual fees, and Amex gets interchange revenue from merchants. So there's kind of different schools of thought on this, but I really think the credit card industry is having a strong year.
And in terms of what people are actually taking on that credit card debt to buy, it's different if you're sort of buying it on big ticket, fun items versus your necessities, like your groceries and your must-haves. What is that telling us? What picture is that painting for us about the kinds of debt that people are taking on?
This is kind of the K-shaped economy in a nutshell. We have some people doing quite well, and they're financing pricey trips to Europe and hopefully paying them off right away. And getting the rewards. And that's a very different scenario from somebody who's using a credit card just to make ends meet. And we're seeing that as well. We're seeing more people putting day-to-day necessities like gas and groceries on cards. And that's a tough situation. The fact that about half of cardholders carry debt from month to month, it's 47% to be technical. That's up 8 points from 2 years ago. And 60% of these people have had their debt for at least a year. And that's up from 50% 2 years ago. So it really is the proverbial tale of two cities here. People who use cards for rewards and convenience versus people who are using cards as really a day-to-day financing mechanism. And that's where those 20% plus interest rates really become a tough cycle to break.
And at what point then do you think we're going to see that really feel in the consumer in terms of how they're spending in a higher for longer interest rate environment, when you do have this divergence between those who can afford to quickly put things on a credit card and pay them back, those versus those who are barely making it?
Higher for longer is definitely a key theme, and that's going to make it increasingly difficult, I would say, to pay off this debt because there's a cumulative toll to month after month of high inflation, higher interest rates, maybe you've depleted your savings. My best advice for anybody with credit card debt is to take out a 0% balance transfer card. I'm actually really pleasantly surprised how generous these terms have remained despite the rising rate environment. You can still avoid interest for up to 21 months on a card like the Wells Fargo Reflect or the Citi Simplicity. So there is help out there. There are also a lot of reputable nonprofit credit counselors like Money Management International and GreenPath. I think, though, this gap will continue to grow because rates are not going to come down in a meaningful fashion anytime soon. So we're probably stuck with 20% plus interest rates for the foreseeable future on credit cards. That's where you need to bring it upon yourself to pay this down as soon as you possibly can.
Indeed, and certainly read all the small print before you sign on the dotted line. A big thank you there. Ted Rossman, Bankrate Senior Industry Analyst. Thank you so much.
Thanks for having me.